Morning all. Thanks for attending the webinar. Whole idea of this webinar, we have seen that many of our clients coming back, especially on the real estate side, on the NRI, that how to handle the taxation and how to get the funds without having any sort of issues. And what we have seen that, especially for the NRIs, it need a bit of a more planning. And secondly, I think the most important part which we have to look at, what is the objective for which we are doing the this transaction, because if we are looking at from a long term perspective, then the objectives will be differ from a case to case. So before I take more on detail, I want to first take you through that how as a India as a market is going to do. If you look at overall overviews that Indian economy will be 7 trillion plus by 2038. So one thing which we can look at and plan it, that India will be a strong destination in terms of investment perspective, especially if you look at next 10 years will be the decade of the India, and all views that next 7 years our GDP will get doubled. And the major part, if you look at apart from the demographic dividend, today I think the way digital infrastructure has been built up, and our view is that manufacturing will lead this time of a growth. So that will be more of an inclusive growth where there are multiple sectors will get impacted and benefited with the manufacturing growth. And this is something where we believe that even somebody is looking at to exit from real estate, reinvesting back in India make a lot of sense, because next 10 years India will be in the highest growth path. And if you look at what are the reasons, because one of the most critical part, if you look at, is the working age population, which is going to be higher on India side. And secondly, if we look at the productivity perspective also, we will have on the higher side, which will lead to incremental growth. That is one of the reason. If you look at post COVID, most of the countries realize that they cannot depend on single country, especially on the China. So China plus strategy, along with that, India has come up as a major second option, because there are multiple other smaller countries, but they are not in a size that they can handle all sort of large business opportunities. So our view is that post exit from a real estate, India will be the very strong destination from the investment perspective. And we will discuss later what are the different options available. And one of the thing which we wants to highlight, that globally market perspective also, even in the US term also, India has done phenomenally well. So if you look at after S&P 500, India has given highest return compared to any other country. So India is the major part of allocation, should be for any portfolio from an investment perspective, not just as an option to save the taxes. It should be an option from a growth perspective also. So, what are the changing trends? If you look at, I think Indian GDP has grown significantly, and equity markets had done phenomenally well. And overall population perspective, also what we have seen that India is doing very well. So people have started looking at India as a very strong option in terms of overall their objective perspective. So I think, as we understand from the whole thing, that India is going to lead the growth. Now the major thing come, if we look at that, how we should plan in terms of post real estate exit perspective, because one of the major thing which is coming for us is that what are the areas of reinvestment we have today. So one of the thing which we looked at in terms of the allocation perspective, what we should plan. So the second options, what we looked at and what we thought would make sense for the thing, reinvestment option and capital gain option. So I think these are the different areas in which we can look at from the investment perspective. One is we can plan to reinvest again in the property. Second is offsetting with the capital losses, invest in the bonds, capital gain account scheme, and fifth option, investment in the stocks. These are the five options which are available for someone after he take a exit call. But the most important part is that before you take a exit call, you have to have a clarity what you are going to do it, because once you exit you don't have any option. So many a times what we have seen that people do a mistake that they exit and then they start looking at for buying another property, and which may not work out well, and they end up paying the capital gain tax. So the first foremost thing is that before taking a call on the exit, somebody needs to plan that what is the end objective for which they are going to do. If they are looking at to reinvest again back to the property, then they should plan it much more earlier so that they don't need to look at later part of the thing. The second thing which we look at where people end up doing is that not following the compliances in terms of keeping money into the capital gain account. So in case if we are not able to finalize on the real estate side, then within a 6 month we should look at to put money into the capital gain account scheme, and before we do a tax filing. So before tax filing, money should be in the capital gain account scheme. And third option which comes, investing into the bonds. So in case amount is below 50 lakh, then investing in the bonds can be looked at, so wherein we get 5.25% annual interest. So I'll take each all the options. First option, which I told, capital gain account scheme. That is predominantly for the objective is that if we are looking at to reinvest back into the real estate till the time, we should keep it money into this. And this is something which we have to do it before we do the tax filing. Then second option, which is investment in the bonds. So there are three government entities currently in which we can look at. Like four are there. So one of them are not currently accepting. So like REC, NHI, PFC, and IRFC. So these are the four bonds which we can select to invest. There is no difference in terms of return perspective in any of the bonds, and all are the government backed. So we can look at any of the options, and 50 lakh is what can be invested maximum from the capital gain account perspective, and 5.25% is the interest rate, and which is paid annually. So this option also make a sense for someone who is not looking at to put it back money into the real estate from a liquidity perspective, because many times what we have seen that just to save the tax, people end up buying the real estate without realizing their needs. So here, at least money will get locked for 5 years, but at least after 5 years, you will have a complete liquidity with you. So this option also make a sense. So first option, we look at putting money to the capital gain bank account, which is not cannot which is open only with the selected banks. Most majorly, it's with the PSU's bank. Second option, investing into the bonds. Then we look at the third option, which is investing in the stocks. This option may not be effective for all the investor, because there are multiple conditions which is required to be fulfilled for a company to be considered to get funds in the MSME segment, and especially they have to be recognized as a startups, and the SSC who is doing investment, he has to have a 25% plus voting rights on the company. So this could be only for people who are interested to start something in India along with others, and wherein they see this could be one of the option to look at. So it may not be relevant for most of the people. But this is one of the option which is started recently by the government. Then next part comes invest again in the real estate again. So if you are buying a new house till from the sale of 2 years from the sale of old house or construction for 3 years. So this is the time what you have. And what we have seen here that most of the times people do a mistake that they buying under construction property which is at a risk that registration will happen within 2 years or not. So if somebody is looking at reinvestment back in real estate, he has to should look at property which are like a ready to registration or within a 1 year. They should not take the risk with this part because later part you may have a risk of from the income tax department perspective. Secondly, after you buy the new property, you have to hold it for minimum 3 years so that you will not end up losing the tax benefit what you have received. Another thing which I think which have recently come up is in terms of the amount perspective. If your overall capital gain is below 2 CR, then you can look at even to investing into the two residential property which was not earlier. So that also be a case where people who are looking at reinvesting back in real estate, they can look at multiple investment opportunity also. The most important part, I think, on the real estate sale perspective, if you look at if someone is planning that he may have a lower tax liability because of the overall tax angle perspective. So he can go to the authority and request to get certificate for the lower tax. So that is something which many of times people are not aware. So if you look at for NRI as a condition perspective, if you look at what are the things which are there, first is non-availability of the slab. So there the tax needs to be considered even they don't have any Indian income as per 20% tax slab if they are not if there is any tax liability. And second thing, tax needs to be deducted at a source by the buyer. So that also is the one thing which they have to look at, and that's a buyer responsibility to deduct the tax. In this case, as a seller, they have a opportunity to reduce their tax liability if they, before they execute the deal, if they go to the assessing officer that they are planning to reinvest into the real estate or they are planning to invest into a capital gain bond or any other condition, so they can reduce, they can get the lower TDS reduction so that unnecessarily the refund thing will not come into the picture. So that's a one point which somebody needs to look at before they planning to exit on the real estate side. That before they get the money, apply with the assessing officer for the lower tax if it's applicable. Secondly, the most important part come if you look at in the brief perspective in terms of post exit. If somebody is looking at taking money back to the respective country, so I think they can get the same, but there's a limit up to 1 million USD only in a year. It is possible, which includes all other income also. In case if somebody already have some interest income, rental income, all together. So in a year, up to 1 million USD is what allowed to take, and there is a Form 15 CA which is required to be get filled and submitted before looking at to take the exit. So if you look at on a brief level, what are the conditions on the taxation perspective? A long-term capital gain about 2 years, short-term up to 2 years. Then which are the benefit sections which we can look at? Section 54, if somebody is looking at to reinvest back into the real estate. Second is Section 54 EC, which is related to investment back into the capital gain bond, and the last part, which includes section 54F, which is investing back on the real estate side. So these are the three major part of the thing in terms of reinvestment perspective. The next part come is that if somebody is looking at reinvesting back into the financial instruments, so if someone is okay to pay the tax, so here also one thing which we have to look at, it is not just the buying value and the selling value. There is something called indexed value. So government of India give every year the index value. So for someone who has having a real estate from a very long time, so for them the index value will be differed. So for example, if you look at the base index value started from 2001 to financial year, so that was 100. So from there and today, if you look at the index value, that is 348. So last 22 years, if you look at three and a half times, already cost will increase. For example, somebody is having a property of a 10 lakh. He bought in 2001 too. Today, the index value of the same property will be 35 lakh. So in case if he's selling, for example, that property at 50 lakh, so he has to pay the differential tax on 15 lakh, not on the actual purchase. For example, 10 lakh is the purchase cost. So he has to pay on the differential 35, 50 lakh minus 35 lakh, which is 15 lakh on that 20%. So 3 lakh will be the net tax liability as a whole. So many times we have seen that people don't realize that how the value of property get increased in terms of index value perspective, and there they can reduce any sort of a transfer expense and other thing. So technically, for someone who is looking at from a high growth perspective and liquidity perspective, reinvesting also make a lot of sense, because at least investing into the stocks, mutual funds, they can expect returns which could be even post paying tax on the higher side if someone is getting 15% type of a return. So that is something which is depend on the individual to individual perspective, based on what is their overall goals and their risk appetite, and what is the objective for which they are doing the thing. These are the different options: investing into the stocks, mutual funds, fixed income, again putting it back in real estate, term deposit, PMS, AIF, and NPS. I'll take you through some of the options which we think make sense before. What are the different services that we look at in terms of overall NRI service perspective, helping it on the overall planning in terms of cross-border remittance, legal consulting, retirement planning, legacy, and trustee services. Because what we have seen that there are a lot of things which are involved in terms of real estate perspective, and along with that we look at adding multiple areas to work as end-to-end planner for them. These are some of the options, just to give you a sense that reinvesting back into mutual fund stocks also make a lot of sense in terms of the growth perspective, because if you look at the long-term returns from these options, they will be much more higher than even post paying tax. Like funds like if you look at like just given an example like Parak Flexi Cap, last 5 years it has given like 19% type of a return. So somebody he put it back money into reinvesting into mutual funds. So after paying tax also the net gain will be much more higher than what he would have seen, and plus he will have the liquidity also. The another option in the multi-cap category, for example, it is giving 15%. So even somebody is having a 15% type of a return, still it is much better than paying it as a tax. The only challenge is that he needs to have it a long-term view, and he has to look at all these things from a 5 year perspective. So many times what we have suggested our clients that just from a saving a tax perspective, not look at the investment, look at with your goals and objective, and look at your risk profile and the liquidity also as a major part, because today if someone is looking at from a 5 to 10 year perspective, equity can deliver 15% type of a return, which is at least will be on the higher side compared to any other alternative option. Then the next part come investing into the PMSs, which is the managed equity portfolio, where we have built multiple strategies and just given a comparison of some of the funds how they have delivered. So if you look at most of the funds, including our own fund, have delivered phenomenally well. Like last 3 years, almost 27%, 5 years, 15%. So 22% one of the fund and mid cap have delivered. So what we see that 15 to 20% of a return is possible if somebody have a long term view, and that is something which can help them to get better yield. And someone who is looking at on the lower risk perspective, then AIF come into the picture, wherein in AIF, predominantly returns will be between 12 to 15% lower side, because there typically they do the hedging as a fund level perspective to reduce the overall risk. But in terms of the yield perspective, even getting post tax 12% is much better than reinvesting back into the real estate. So that could also be a one alternative option for someone who is looking at not to go very high risk perspective and want to protect the downside risk, especially in the markets today where markets have run up. So we have just put it some of the options like different funds within a AIF category like Nuvama Edge, Tata Equity Plus, Avendus, Alpha Mine. These are some of the funds which are able to given 12 to 15% type of a return in last 1 or 2 year perspective, and this is something which we can look at even from a long term perspective. So just to summarize, what are the tax exemptions is there for NRI? If you look at interest earned on their FCNR and NRI is a tax exempt, or interest earned on any of those notified government securities. NRI can have an exemption under Section 54, 54EC, and 54F on the long-term capital gain, which is applicable, and they can avail from the exemption of capital gain when filing the return and claim the refund. But what we would suggest that instead of going through that route, even they can apply with the assessing officer before itself to get the certificate for lower capital gain deduction, so that later stage it will not create a problem. So I think in summarize, if we look at what are the key things which somebody needs to look at before exit, first thing, what is the plan post exit? If they want to invest into the real estate, then they should identify early. Secondly, they should not invest into under construction property, because it may get delay and it can impact the tax benefit what they are supposed to get. That's the first part. Second part is that if their risk profile is conservative, then they can look at investing into the bond for up to 50 lakh. Could be the second alternative option. The third option could be if somebody who can understand market and take a bit of a risk, then for them even paying tax and reinvesting back money into the capital market also makes sense, because in long term it work better than any other instrument. Only thing is that somebody needs to look at from a 5 year perspective, because in short term it may differ. And the another thing from an NRI perspective, they have to look at countries where DTTA provision is there, where government of India have a TT with the other country. So in that case, if they have a lower tax liability provision, for example, countries where the tax liability is on the lower side, in that case, they can get the certificate and request for the lower tax reduction instead of paying getting it later as a part of the refund. And the most important part, I think, which we have to look at is that compliance needs to be followed properly, because most of the times, the in case of NRI, people don't pay the TDS while selling the property. They don't update buyer that it's an NRI case, and they end up paying penalty later. First thing, we have to identify that if, as per the income tax rule, we are the NRI, then we have to make sure that when buyer is buying the property, deduct the TDS, and if possible, get the certificate from the CA to get the lower tax if it possible in terms of the investment perspective. Secondly, make sure that amount are get deposited into the capital gain bank account before tax filing, in case if you are planning to buy another real estate. And these are the taxation, if you look at on the different investments options. So typically, if you look at on the stocks, long term perspective, above 1 lakh of a gain, 10% is the tax liability. So that way also, investing into the stocks or mutual funds are more tax efficient from a long term perspective. I think that's all from my side, Sanjay. And now we can have a Q&A.
Thank you so much, sir, for sharing your valuable insights. I think we are already having one question or suggestion in the chat box. We can take that. Meantime, I would like to request all the participants to put down your questions or queries in the Q&A section or chat box. We will be taking it. Yes, sir. So I think we have a suggestion from Mr. Sivaraman. He has mentioned his views in the chat box. Can you please
Yeah,
throw some
sure.
light on that?
Yeah, I think as we've seen that most of the real estate exit happen from US and Europe, where people wants to settle it back there. Yes, for them, it make sense if they are looking at to buy properties or they want to settle it there. But the most important part is that to understand the complexities of exit and how it needs to be looked at before take a exit call. Because what we have seen that people plan it after doing an exit from the real estate, and they end up losing both the side in terms of tax perspective and in terms of potential gain perspective. So the whole idea of what we are saying that yes, India is a promising country, but as per your goals or objective, if you're looking at putting it, taking it back money, but make sure that you plan it properly in terms of how it needs to be handled. So, like for example, you can have a lower capital gain thing also if you are looking at to invest back some part into bonds and other things. So, the most important part is plan before exit, not after the exit. The next question come in terms of the PMS return perspective, how it work. So I'll just show you. So PMS typically are it's more customized investment solution where concentrated portfolio of 25 to 30 stocks are built up, and which is managed more customized level, and which helps to deliver higher returns. And what we have seen in last 3 years, multi-cap side funds were able to deliver 25% type of a return, and mid-caps are able to deliver between 35 to 40%. So as a whole, if you look at around 20% type of a return, somebody can expect from a 5 to 10 year perspective through PMS if he is having a long-term view. But it make a lot of sense if somebody have a risk appetite and long term view. What are the advantage gift city fund and what are the product NRI can get? Yeah, see, the gift city perspective, the benefit for the NRI is that they don't need to have this tedious issue. So all the investments can be managed without having any sort of a tax complication, and money will be repatriable. So it makes sense for someone who is looking at larger allocation going through a gift city, and we have a lot of products today available, financial products, in which investment can be done through gift city. But yes, still it's at an early stage because there are also things are developing, and you can see next 2 to 3 years gift city will become as a major chunk for the larger allocation. Yeah, the next question came in case, for example, if it's a joint property, and how the tax implication will work. So, see, if you look at from a tax implication perspective, there is no difference if it's a resident Indian or NRI. So the only difference that based on the percentage of the ownership. For example, if son is NRI and father is resident, so for son, tax will deduct at source at 20%, and for father, it will be at a 1% rate TDS reduction if property value is above 50 lakh. So the only difference will come that the tax reduction will happen at a source for NRI, and for resident, it will be at a very low rate, 1%. So that's the only difference. Otherwise, net tax liability perspective, there is no difference. Yeah, so one of the question came that the income from NRE and NRO is taxable or not. How is that? So for NRE income, interest income is taxable. NRO, it will be a taxable. So I think that's the difference. So there's a difference between tax liability for NRE and NRO. NRE being a repatriable, they'll not have any tax implication in India. So it will only have a tax implication on the respective country. If there it is taxable, he has to pay the tax. But from India perspective, they don't need to pay tax on the NRE deposits. Yeah, that's all from our side. And if you have any further questions, you can reach out to us, and we will be happy to help you. Thank you.
Sir, we have two, three questions in the Q&A section. Can we check
Okay. Mm,
that too?
okay. Can an NRI transfer money from NRO to NRE account? It is possible. Only thing they have to take the certificate from the CA with the source of the fund and the purpose. So it is possible, but yes, there is a certain formality which needs to be done before fund can get it transferred. What are the tax implications for investing in property? So in this section, we are covering more tax implication from an India perspective. Later part, whenever we'll cover in terms of the other countries, we will come back to you. If property is bought from the NRE account, can the sale proceed can be taken to NRE account, or is it mandatory to take into the so you see if its funding is done through NRE account, it can be taken back to the NRE account. There is no as such issue. The only thing is we have to make sure that TDS has been taken care before remittance happen. Yes, there is a certificate, and there is a limit for a financial year for 1 million USD is there. So that limit is there for a one financial year perspective. So both thing is there. We need to have a set 15 CA and CBA and 1 USD limit. So both thing is applicable.
Yeah, I think, sir, we have taken
And the
one
one
more
more
last
question
question is
came
there.
in.
We can take
Yeah,
in
yeah.
chat box.
So if you're investing back to another property, you can get a waiver of a tax. But for that, before you do the registration, you have to request to the SSC officer to share with him the capital gain calculation, and he will give the certificate for lower capital gain tax. That's what I was telling that. these things need to be done before somebody look at getting money from the exit. If it is possible, you can have a waiver of tax paying if you're buying a property, but for that you have to get from the SSC officer certificate. And the instrument to save tax, as I told you earlier, there's only one instrument apart from investing back into the real estate. For most of the people, is investing into the capital gain bond. But there also limit is 50 lakh, and money will be locked for 5 years, and interest rate will be 5.25% annually, and interest will be taxable. Other option, which is investing in the startup on the SME side, it may not be applicable for all because the multiple condition which is not easy to fulfill for the investor. So if you go in general, I think the only option left over apart from investing into real estate, put it money into the capital gain bond.